Hello. I want to talk a little bit about credit sales and kind of ways that companies would account for them and also account for situations where some customers do not pay. Just kind of talk about that. That's going to be our subject kind of today. So let me go ahead and bring up the Excel file. So I've got an Excel file here, and just kind of to start off with, a credit sale would be if you made a sale to a customer on account and you're going to give them, say, 30, 60, 90 days to pay you. You would debit accounts receivable. Let's say it's a $2,000 sale. You'd debit accounts receivable and you'd credit sales or sales revenue. You're going to recognize the revenue there. So let's say it's a credit card sale. A lot of companies offer credit cards to their customers, and it helps their business. Not everybody has cash, and so it's just easier for a lot of customers to pay by using a credit card, a Visa or American Express or Discover card. So let's say that a $200 sale is made with a Visa card. The customer uses Visa, and let's say Visa has a 3% credit card fee. Now, one thing to kind of say here is that credit cards make money not only off the interest that they charge individuals whenever they kind of maintain or keep a balance. Credit card companies make money by charging a fee to the stores that use them. So if a store accepts Visa and I go in there and I use my Visa, they're going to pay probably anywhere 2, 3, 4% to Visa. American Express and Discover, typically it's going to be about 4 to 6%. So Visa's a little cheaper, so that's why pretty much everybody takes a Visa, but some people don't take American Express or Discover. So again, I made a $200 sale to a customer. They use their Visa card, and Visa charges my company a 3% fee for doing that. So how would I recognize that? Of course, I would credit sales for the full amount of the sales. I would take then 3%. 3% of the total sale then would be basically going to Visa. So I would debit an account called credit card expense, and that is an expense. And then I would debit cash for the amount of cash that I'm actually receiving. Now, companies go ahead and just debit cash for credit card sales like this because typically they have an arrangement where the money is going to come into their account next day or the day after. It's a pretty quick turnaround. So companies just go ahead and debit cash. Credit card companies going to pay them pretty quickly. They tend to have arrangements like that. The credit card company actually will just go ahead and take their fee out of the payment. So the company will submit this sale and then they're for 200 and then they're going to get back 194 with the fee taken out of what they're getting back from the credit card company. So just kind of think of how credit card sales are handled in terms of a business. And this is a good example right here. Now, what happens though when you're offering credit to regular customers? Like you have regular customers and you agree to provide their service or sell them your product, and they pay you back every 30, 60 days. Of course, that would be accounts receivable. That would be kind of like the first transaction that we looked at up here. But what happens when customers do not pay? There's always just going to be some situations where customers don't pay. Either the customer passed away, the customer might have filed bankruptcy, might be some other issue arise. But basically, there's always going to be some instances where the customer does not pay you. So how would you account for that? How would you take care of that? One way, if you're a really small business, the direct write-off method that we're going to look at here first is a good way for companies to handle this. And if you're a really small business, this would work great. This would be probably the best method for you. Now, the direct write-off method, what would happen is, hold on a second, I jumped down a little too far. With the direct write-off method, what would happen is once you determine that you're not going to collect, which typically most companies about once a year, maybe twice a year, they look at their customers that owe them money, especially the ones that are past due, and just kind of make a decision. I don't think we're ever going to collect this amount. And they go ahead and just write it off. And it benefits them because think about it, when you registered the initial sale, you were going to pay taxes on that. And so by going ahead and writing it off, if you're never going to collect, you have reduced your tax burden. And so it is good for companies to do this once or twice a year. Just go out there, and if they feel like they're not going to collect, write it off. And so basically, let's say that we determined that we were not going to collect a $500 balance from a customer. So we would debit account called bad debts expense. We would credit accounts receivable, and we've just written off the account. So it's a done deal. This customer will no longer owe us money, and we've written it off. We've given up trying to collect these funds. So we've just reached a point where we don't feel like we're ever going to get paid. Now, one of the things I would tell you is that it does benefit a company when this occurs to send it off to a credit bureau. Because if you send it off to a credit bureau, then it's going to kick out, and that person's credit is going to take a big hit, or that business's credit is going to take a big hit. And what's going to happen is sometimes the customer is going to go to buy a car, rent an apartment, or get a house, and they're not going to be able to do so because their credit is bad. And having a charge off will really reduce your credit balance. And so sometimes the customer then will want to come back to you and pay in order to get their credit rating updated or upped or increased, so they can then go buy a house or go buy a car or do what they want to do. And so if they come back to you and want to pay, you would basically reinstate the balance. So you would reverse what you did when you wrote it off. You would debit accounts receivable. You would credit bad debts expense. You're basically reversing what you did to write it off. And then you would accept payment. So this would be just like any other payment. If the customer had made the payment initially, you would debit cash and you would credit accounts receivable for the amount of the payoff, for the amount of the payment. Now, a couple of things here. Most companies will not reinstate an account unless you have the cash to pay them right then. So you wouldn't want to do it just, oh, I'll pay you. You wouldn't take their word for it whenever they stiffed you the first time. So you would not reinstate it until they paid you, or they were ready to pay you right there. And then basically, once you've received payment, you would update it with the credit bureau, and then the charge off would come off their account. Their credit score would go back up, and they would get to go do what they want to do. And so by submitting it to the credit bureau, a lot of times that helps you as a company to attain payment. And so again, just a good business strategy to do in this case. Now, if you're a small company, like I said, this method would be great. This is a good method if you're a small company. But if you're a bigger company, or if you're a publicly traded company, then you would want to do the allowance method. And the allowance method is a little more complex. But if you're a bigger company, or if you're a publicly traded company on a stock exchange, this method is required. You're required to do the allowance method. But most big companies, medium-sized companies, even some smaller companies use this method. And there are two reasons why this method is better. This is a little bit better method from an accounting perspective. One is the matching principle, in that if you're doing the allowance method, you're going to match revenues and related expenses in the same period. That's one of the big improvements over the allowance method over the direct write-off. And another thing with it is that with the allowance method, as we're going to see in a few minutes, you will show on the balance sheet the amount of accounts receivable that the company actually expects to collect. And so because of those two items, the allowance method is deemed to be a better method from an accounting perspective. Publicly traded companies are required to use it, but most large and mid-sized companies use this anyway, even if they're not required, because it is a better method. Now, there's three ways to do the allowance method. The first one would be the percentage of sales method. And let's say, for example, in this example, that for the month of September, you have $100,000 in sales, and the company feels like 3% will be uncollectible. So if you're doing the percentage of sales method, you're typically going to do this as an adjusting entry at the end of the period, and you're just going to take whatever sales you had in that month, what times whatever percentage you feel like you're not going to collect, and that's how you're going to record the adjusting entry to record what you feel like you're not going to collect. So in this case right here, we would just take basically 3% of 100,000, which would be 3,000, and you're going to debit bad debts expense, and you're going to credit a new account called the allowance for doubtful accounts. So this would be the journal entry you would make in this case. Now, the allowance for doubtful accounts is a contra asset account. It is related to accounts receivable. And basically what the allowance account represents is what you feel like you're not going to collect from accounts receivable. And so this is kind of what it would look like on the balance sheet. A company would basically have their accounts receivable balance, which would reflect everything that's owed to them by their customers. That's what it would be reflected here. And then less the allowance for doubtful accounts. The allowance for doubtful accounts would be, again, what they feel like they're not going to collect. And then you would have net accounts receivable, which would be the difference. Now, so this is what it's going to look like on the balance sheet. Now, again, remember earlier I said the allowance method was a better method, and one of the reasons was the matching principle, that it matched revenues and related expenses in the same period. And another reason I said is that it allows companies to show accounts receivable on their books, not just in the total, but based on what they feel like they're actually going to collect. This is how that would look. The net accounts receivable in this example here, the 77,000, is what the company feels like they are actually going to collect. So again, a better way to show accounts receivable on the balance sheet based on using this method, the allowance method. Now, another reason that this is the preferred method, again, just like what I was saying, that it reflects what the companies feel like they will receive from their customers or collect from their customers. Now, if you're using the allowance method, percentage of sales is probably the easiest of the methods. There's two other ones that we're going to talk about next. Now, what if you have to write off an account? Notice that when we made this entry, this was more of just a general entry of what we felt like we were not going to collect based on the sales that we made during the period. That's basically what this is right here. Now, so if we wanted to write off a $500 balance, then what we would do is we would debit the allowance for doubtful accounts, and we would credit accounts receivable. Now, notice with this journal entry to write off an account, since we're doing the allowance method, and since we recognize the expense with our initial entry, notice the initial debit to bad debts expense, we've already recognized the expense. And since the allowance account is set up to be whatever we feel like we're not going to collect, then we would just basically take any actual write-offs out of the allowance account. That's all we've got to do in this case. And notice that you'll see that down here. Again, when we're writing off the account, we're just taking it out of the allowance account because we've already recognized the bad debts expense when we made the adjusting entry. So we would just take any accounts we're writing off out of the allowance account. Now, again, what if the customer comes back and wants to pay? Kind of like what we did earlier, what we looked at earlier. Then we would just reinstate the account. So notice here, we're basically reversing what we did up here when we initially wrote it off. We're going to debit accounts receivable. We're going to credit the allowance for doubtful accounts. And then we're going to accept payment. When we accept payment, we would debit cash and we would credit accounts receivable here. So this would basically be us accepting payment. So the one method is percentage of sales. And all we do with this is just whatever percentage of sales that we feel like we're not going to collect, we would basically just write off. Now, What about the percentage of accounts receivable method? This would be basically percentage of accounts receivable method. Basically, the balance, let's say that the balance of there's $8,000 in accounts receivable, and the company feels like 5% will be uncollectible. Then basically what we'd do is we'd take the 80,000, that should be, let's make this 80,000. There we go. Let's say there's 80,000 in accounts receivable. The company feels like 5% will be uncollectible. So we would just take the 80,000 that's in our accounts receivable times the 5% that we feel is uncollectible, and that would give us $4,000. Now, if we're doing the percentage of accounts receivable method, whatever percentage of accounts receivable that we feel like we're not going to collect is going to equal our ending credit balance in the allowance account. So this is going to equal, so whatever percentage of accounts receivable we feel like we're not going to collect, in this case 4,000, that should end up being our ending credit balance in our allowance account. So how we do our adjusting entry is going to be a little bit different with the percentage of accounts receivable method, because we're going to have to take whatever balance is currently in the allowance account, whether it's $1,000 debit balance or $1,000 credit balance. Remember, this is a T account. So the debit side is the left-hand side. The credit is the right-hand side as you're looking right at the T account. So if we've got $1,000 credit balance, then our adjusting entry needs to be whatever it takes to have a $4,000 ending credit balance in the allowance account. If we have $1,000 debit balance, our adjusting entry would have to be for whatever it takes to have a $4,000 ending credit balance in the allowance account, because that's the percentage of accounts receivable that we feel like we're not going to collect. So the difference between percentage of sales, percentage of accounts receivable, is how you handle the adjusting entry for bad debt expense. That's basically going to be the only difference between the two methods. Now, so let's come down here. If we had $1,000 credit balance in the allowance account and we needed to make it 4,000, then we would just debit bad debts expense for 3,000 and credit the allowance for doubtful accounts for 3,000. Now, what if there was $1,000 debit balance in the allowance account, like this example here? Then that means we would have to credit it for 5,000. So we would debit bad debts expense for 5,000 and credit the allowance for doubtful accounts for 5,000, because our only goal is our adjusting entry for bad debt expense has to be enough to make the ending balance in the allowance account equal whatever percentage of accounts receivable that we feel like we're not going to collect. That's the goal right there. Now, so let's say we're going to write off a $400 account. We would handle it the same way as we did with percentage of sales. And that is, we would debit the allowance for doubtful accounts for 400. We would credit accounts receivable for 400. If the customer wants to come back and pay us later, then we would do it the same way we did under the percentage of sales. We would debit accounts receivable. We would credit the allowance for doubtful accounts. Basically, we're reinstating the account, so we're reversing what we did to write it off. And then we would accept payment. So we would debit cash and credit accounts receivable. Now, so notice that except for how they did the initial adjusting entry, everything is the same between the percentage of sales and percentage of accounts receivable. Now, we're going to look at another method here called the aging schedule method. And this is the last of the three ways to do the allowance method. So the aging schedule method, you're actually going to prepare an aging schedule. And a lot of companies prepare an aging schedule even if they don't use this method, because it's a very good way to look at the current customers that owe you money, if they're overdue. And it's good, like a lot of times accounting will prepare this and give it to the credit department, because it shows them the customers that they need to be contacting and really working on to collect. So in this case right here, the aging schedule would have all of our customers that owe us money listed. how much of what they owe us is current, which would mean it's not past due, and then it would list the past due amounts and how past due they are. 1 to 30 days past due, 31 to 60 days past due, 61 to 90 days past due, and over 90 days past due. And it would list all of the amounts here. Now, and then this total over here would basically be our total accounts receivable. And this total accounts receivable would be broken down by how current or how behind the customers are in payment to us. So one thing you're going to know here is like the total current would be 26,000. Now, notice that there are percentages here. This would basically be our uncollectible percentage right here. This amount right here would be our uncollectible percentage. So notice that of the current amounts that are due to us, only 1% is deemed to be uncollectible. So 1% of 26,000 would be $260. Of the 1 to 30 days past due, $2,000. Notice that 3% of this is deemed to be uncollectible, and that would be a total of $60. Now, one thing you're going to know with the aging schedule, and think about this from real world, from true life and your own personal experiences. The longer that someone owes you money, the less chance you're ever going to collect. So the percentage of uncollectability, notice here for 31 to 60 days, increases to 10%. The longer that something's past due, the less chance you're ever going to collect. So our percentage of uncollectability will increase the longer something is past due. 61 to 90 days, 25%. Over 90 days, 50%. And so let me go ahead and make these percentages too. They'll just be a little bit easier here to see. So again, the longer something's past due, the greater the chance we're not going to get paid. So we add these across and notice that the total is $2,620. So if we're doing the aging schedule method, then whatever the total of the aging schedule is, the total that we feel like we're not going to collect based on the aging schedule, in this case, $2,620, that should be then the ending credit balance in the allowance account. In this case, the 2620 should be the ending credit balance in the allowance account. The allowance account is going to be similar to the percentage of accounts receivable, and that the amount of your adjusting entry is going to be calculated in a very similar manner. It's whatever it takes to get the current balance to equal, in this case, the balance that the aging schedule has put forth to us as what we feel like is uncollectible based on the aging schedule. So kind of going down the list here, if the allowance account had a $1,000 credit balance, then our adjusting journal entry would be a debit to bad debts expense for $1,620 and a credit to the allowance for doubtful accounts of $1,620. So now, so and it's the same thing. If it had a debit balance, then it would be calculated differently as well. But just kind of think of it, it's calculated as the same way as the percentage of accounts receivable. Whatever you get for the total of the aging schedule, this should be the ending credit balance in the allowance account. And whatever balance is in there before this entry, your adjusting entry would be to make that equal the total uncollectible amount from the aging schedule, like you see here. Now, everything with writing off an account and the customer coming back would be handled in the same manner as the other allowance methods. The same manner as the percent of sales, the same manner as the percent of accounts receivable, writing off an account, customer coming back and wanting to pay, reinstating the account, paying account, all that would be handled the same way. The only difference between the percentage of sales, the percentage of accounts receivable, and the aging schedule method is how do you handle the initial adjusting entry to recognize bad debt expense and to record the allowance for doubtful accounts for what we feel like we're not going to collect. That's the difference between the methods. Okay, so that is all for this chapter. Get with me if you've got any questions. It's an interesting subject, and this is very applicable to business because businesses have to work with this all the time to make credit decisions and business decisions based on this information. Thank you, and have a good day.